Hey, welcome to my channel. In today's live stream, I'm going to be going over what I saw in the market. It's been a fun couple of days. Wednesday and today's trading. Today is Thursday, December 14th. We saw the small and mid cap stocks really do well. It was really interesting to see that really play out. We also saw new sectors come into the picture that did really well. Everything was influenced by the Federal Reserve's decision to hold interest rates where they're at. And they had some comments that were perceived to be favorable towards stocks. So as we set up 2024, it looks like December is going to be a really good month. I still expect that the market has seen 6 straight weeks of up stock prices. We're working on week 7, and it just seems like we should be getting at least one down week, maybe 2 in the month of December. I'm not sure it's going to happen this week, but maybe next week we should see a pullback. I'm just expecting it because it's just it's too good to be true, I guess. The stocks have been going up and up. So let me take a look at a couple of things, or let me show a couple of things that I observed in the market. Go over those things and see what you guys think. So looking at the indexes, the Dow Jones was up. It's been having a really good month or two. The S&P went up just slightly, 0.26%. The NASDAQ went up 0.19%. But the Russell, which is made up of a lot of small and mid-cap stocks, that's what really took the show today. It was also up, I think, about 3.5% yesterday. So it was a huge move over 2 days, showing that investors are moving away from the big mega cap stocks and looking into small caps. A couple of reasons is you have lower interest rates, so it really affects the way you value those companies. Small stocks tend to be more risky, but when you lower interest rates, it really changes the valuation of those stocks. Hi, welcome to the live stream. So I think the small and mid cap stocks, they really took the show today, and I think it's going to stay. It's going to be a theme that will stay for at least a couple months. And the reason for that is if you look at the 2 indexes I'm comparing here are the Russell 2000 in blue and then the S&P in yellow. And at the beginning of the year, you had, the indexes were kind of trading close together. The Russell 2000 of small stocks actually went ahead of the S&P, but then it really fell significantly downward. And when that occurred, the small stocks really stayed behind the S&P. The Magnificent Seven just took off in kind of the late spring and really pulled away from the Russell 2000. The reason I point that out is if the small mid-cap stocks were forgotten, then they're probably heavily discounted. And for value investors, that's good news. That means that stocks in this area here, which is in the months of, call it from late July, I think was the peak, all the way through toward the end of October, you saw stocks being sold off, and small and mid-sized stocks were sold off at a greater rate. So they were more discounted. Now that I think investors realize that, hey, they're a really good investment, they've really taken off. And I'd like to show kind of like a shorter time frame graph to show how dramatic the change has been. Looking at the Russell 2000 for the last month, it's gone up 11%, which is really dramatic. Compared to the S&P, it's up 4.8%, which isn't bad. It's very good. But the small mid-cap stocks are growing 2 times faster. So really interesting to see that. If we look at just the Russell 2000 from the very bottom, the trough, up to the peak, the the Russell 2000 is up 22.21% since October 27th, which is a huge, huge move. Really good to see. And that's less than 2 months. It's up 22.21. That's a whole index, 2,000 stocks moving, not all of them moving in one direction, but for a whole index to move that much is pretty incredible. So that was a big observation. You're seeing it across YouTube and on CNBC and Bloomberg. A lot of fund managers are pointing out that, hey, small mid cap stocks are probably going to be performing quite a bit better than mega cap stocks. And I'm glad that, if you watch my channel, I've been talking about small mid cap stocks for some time. More importantly, for me in my portfolio, I've been buying into small mid cap stocks. So I have really good positions in a couple of different sectors. So I really rode these 2 days. It's been a fun 2 days. It's really benefited my portfolio. So small mid cap stocks are really working. Let's take a look at sectors. So I'm looking at sectors from the best performing to the worst performing today. And the best performing today ended up being energy. And energy had a really good day because oil prices went up. I think they went up a little over 3%, which is a big move in oil. But the space itself has really had a bad year. For year to date, it's down 7.3%. Last 3 months, it's down 11.94%. So oil and energy, not sure I could say it's going to have a good 2024 because it's all predicated on oil prices. If oil prices are good, then it's going to do well. If oil prices are not good, it's going to do poorly. But I'm believing that oil is a scarce resource, and over time it tends to go up in value. So I can't say that 24 is going to be a good year for oil or a bad year for oil, but I'm an investor in Chevron and I'll keep my investment there. There's probably other good investments there. Some news in that sector: Warren Buffett decided to up his stake in Occidental Petroleum. So, one of the best, if not the best, value investor of all time, really believes in energy. So I'll follow his lead and continue to have my investment in Chevron. The second best performing sector was real estate. It was up 2.6%. And real estate, I think it's a combination of things. Is one, it was kind of left behind. A lot of people dismissed real estate because of high interest rates. And I think, especially for commercial real estate, I think the occupancy and the vacancies were a big concern since there's so many people working at home now. So real estate's really rebounded quite well, especially with low interest rates. Real estate companies, real estate investment trusts, usually depend on interest rates. So in this case here, interest rates are lower, and that makes these companies more profitable. They don't have to pay as much interest. So I think real estate's rebounding for a couple of reasons. Lower interest rates, and then they were left behind, and now they're catching up. Next couple of sectors: materials. I saw my material stocks really rally, I think because we're expecting that there's going to be no recession, or the recession isn't going to be as bad as first thought of. So that's why materials, I think, are really rallying, because I think the recession that is expected won't be too bad. So let me answer a question here. So I think the question is, do you think the QAD or quad witching day will bring down stocks? I have no idea. If you could be more specific, I have no idea what that refers to. Next sector, industrials. Industrials kind of follow materials. I think as the economy improves, I think it's going to rally. And these are sectors that historically have done well. So I think money is moving into these sectors and out of things like technology, which did great. And the sectors that did really well, like communication services, I'll show in a couple minutes, where those companies are. But I think money's moving from one sector to another. Sector rotation, I believe, is what they call it. And then consumer discretionary is doing well. I'm really looking to that space. I've got some good positions in stocks there, but can always use a couple more. And then financials. Financials has been doing really well. They had an update today. But if you look at the last month, it's up 9.5%, which is really good. And this is another sector that was left behind. It was left behind because people were afraid of the banks. They thought the big fluctuation in interest rates really put bank balance sheets and other financial service balance sheets under a lot of stress. We saw two banks go down in the late spring. So that really caused a lot of fear in that sector. But now, the banks are fine and they're actually collecting more interest in their revenues. So overall, I think financials have been having a great month and a half, and I think are going to continue to do well going forward. Everything that did poorly, communication services, Meta is down, Google is down. They're in that sector. Technology went down a bit. Healthcare has been down just about the whole year. And then utilities and consumer staples were down. All right, let me try to take this question here. Quadruple witching. Wow. So I would like to answer your question, Luminous Blanc, but that's out of my wheelhouse. I'm a value investor, and I don't deal with derivatives and so forth. Hey, thanks for the comment. Thanks for watching the Adobe stock and the HP stock. Just to tell you a little bit about myself, and thanks for getting on my live stream. I'm a value investor. I really like to understand, the businesses that I invest in, and really go through my fundamental analysis. I think it's explained in the videos, but I try not to sway out of that zone. I've tried trading some options, which was interesting, but I felt like it pulled me away out of that core discipline. My intent is to constantly make my portfolio better and earn more year after year from a performance standpoint and an income standpoint. So my main area of focus is just finding good companies, buying them at a discount, holding them, and getting the most value out of them. So sorry I couldn't answer your question on the derivatives. I really appreciate you watching and putting comments on Adobe and HP. Okay, so sectors, right? So moving from sectors that maybe worked in 23, but are probably overpriced, and moving to sectors that were left behind and discounted in 23 and are probably going to rebound quite well in 24. That's something I've been really focused on, trying to stay ahead of the market, trying to see where the market's going to go and buying in advance of everybody else. So that's been one of my efforts, and I'm seeing that in the data. So one thing I wanted to point out, so small and mid-sized stocks did tremendously well yesterday and today. And it's a big signal that, hey, that's a good space to invest in. Now, looking at the Magnificent Seven, which is these 7 huge companies that are, each one of these businesses is excellent. It's an excellent business. That's why they got so valuable. But if we look at the one-day chart for Apple and the other 6 Magnificent Seven stocks, I think a couple of them were deep in the red. It looks like Microsoft went down 2.2%. Amazon went down 0.9. Google went down about 0.5. Meta went down 0.4. And I think Apple was just up a little bit, 0.1. And then NVIDIA was just up slightly. And Tesla was up quite a bit. So you can see that on a really up day, on a week when we got really good news from the Fed, the Magnificent Seven didn't really move. So money's flowing into small and mid-sized caps, and it's flowing into sectors that were kind of left behind and are receiving the new investment. Looking at a broader timeline, if we look at the last month, you have the same stocks, Apple and the other six. And if you look at NVIDIA, it's down negative 2.6% over the last month. You have Google down 1.6, Microsoft down about 1.2, Meta down 0.9, and Amazon's up 1.1. Apple and Tesla are up about 5.7. So over the last month, they didn't keep up with the Russell, and some stocks, especially some small caps. I'll point out Coinbase has just been on fire, and a couple other small cap like Stoneco, that's been on fire. And I've had a lot of small caps just really go up about 25 to 35% in the last month. So while that's been going on, the Magnificent Seven, although they've had great years, have been kind of stale. All right, let me take that question here. So question is, when you are doing your PE ratios test, are you using a widget or are you doing it yourself? I do it myself, and there's a reason behind that. I'm educated in accounting. That's where I went to college for. And, one of the lessons that I learned in accounting, and I worked as an accountant, doing both cost accounting and financial accounting for big businesses, is you need to really get down to the data and then construct, in that case, a financial statement. So it's my preference, and you see that in my videos, that I actually go to the financial statements and I draw out, the data and then construct it myself. And the reason for it is a couple reasons. One of them is, in order for me to know the business, I have to dig into their financials and really know that the data represents the business and I can see how the business is working. Now, the other reason is sometimes I go to some of these sites like CNBC or whatever it be, and they might misclassify or calculate, in this case, PE slightly different. And I'd rather depend on my own, model, so I can go through the discipline of knowing the numbers and then constructing that from the ground up. So good question. I do it on my own. The model that you see on my videos, I created that model. I did watch a lot of videos that other investors have created on YouTube. I read books. I kind of put my own investing style together based on my background. And the most important thing for me is really trying to understand a company and understand, that they're discounted and that they're going to have a very good next couple of years. So that's why I construct it from the ground up, is really trying to understand the data, because I want to understand the company and then constructing it from the ground up. So good question. I really appreciate the question. All right. So we talked about the Magnificent Seven, where they're at. And then second thing, I think another question is the model a plug and play? Thanks. So the model that I created is, I think it is somewhat plug and play. It's built in Excel, but I'm going to recreate it in Google Sheets, because I know Google Sheets is free and it's easier to share. And I will eventually, share it with the channel. It might take me some time to get there, because the model has a lot of calculations, net present values, and so forth. But I created it again based on how I like to evaluate a company. I didn't take somebody else's model and then just start using it, kind of like drive the car that they assembled. I wanted to assemble it myself, so I knew how the numbers were working, so I can best understand that company. As you create your models, like when I got started, I did somewhat borrow somebody else's until it kind of all made sense. So that totally is a good way about to go about it. But over time, you should create your own, and you should create something that you feel really confident around, and really know your expertise. I like what Peter Lynch said, which is, we all have kind of our history, our experiences, our education, our passions, our interests, and those are actually what we have as an advantage to the marketplace. And I try to bring that to the table. And like we talked about oil earlier in the video, I worked at an oil company. I worked as an accountant at an oil company. So I can use that experience to my advantage and know, at least back when I worked at an oil company, how they operated the business. And it goes back to the model. It's good to start with somebody else's model, but I would recommend that you intend on graduating in creating your own model, something that fits what you like investing in, what numbers and data you like to crunch, and then what variables you use to make a decision whether you're going to buy, hold, or sell. The other thing I'll throw out there is that you oftentimes hear you buy and hold forever, and I think that's something I don't agree with. And I'll make this point, which is, if you ask me to buy a stock that I think is going to do well over the next 30 years, that's a very difficult question, because I don't know, is Apple going to be good in 30 years? Will we even have smartphones in 30 years? I don't know. I have no idea. Now, if you said, hey, I want you to pick a company that's going to be good for the next 3 years, okay, I can get my head around that. I think, for example, Meta is one of my biggest holding. I think Meta's tremendous. They generate awesome free cash flow. They dominate their market space. Nobody's going to take their market in the next 3 years. They just continue to grow. They're really efficient right now. So I can make a clean decision over the next 3-year horizon. But the whole, hey, I'm going to buy and hold a company forever, I've never really accepted that, because it's too difficult of a question. Or if you have an attitude of, I'll buy a company and kind of park it, not think about it, I don't buy into that either. Because what if the company you bought begins to really operate poorly, or they make a bunch of mistakes and their products are falling behind the marketplace? Well, you just need to come to that realization and sell that stock and get out. I'm not perfect in the stocks that I buy, but overall I have a winning record and I make money year over year. So that's how I treat the hold it forever kind of concept. I wish it was that easy, but it's not. Companies evolve. If you look at the leading companies that were around 20 years ago and look at the short list today, I think the only one that would be on there would be Microsoft. So if you were smart enough to pick Microsoft, good for you. But everything else you picked didn't pan out. So that's my point there. All right. So yeah. Thanks for the comments. All right. So we talked a bit about the Magnificent Seven. So just to, kind of somewhat wrap up the live stream, I was hoping to go about 30 minutes. Here were like the 3 top stocks for me today, and then the bottom 3 stocks. And I'd like to provide a few comments. So the first one, Enphase, and I've got a video of this company on my channel. Once interest rates started to drop, it really changed the expectations on Enphase. With lower interest rates, the expectation that more people will get solar on the rooftops really goes up, because they're usually financed. And it really sent the stock, flying. And it's been flying for the last 2 weeks. It's up, like 30-40% in the last 3 weeks. So Enphase is just rocking. Medical Properties Trust. This is a high risk real estate investment trust, heavily shorted, and it was up almost 10% today. Again, lower interest rates. These guys have a lot of debt. I believe, based on my analysis, that they're going to be fine for the next 10 years, and they pay, at least with their old share price before the big run up that they've saw over the last 2 to 5 days, they're paying close to 13% dividend. So high dividend, high upside real estate investment trust. It really went up today. If it goes up significantly more, it's shorted. It's somewhere in the 20s, like 23% of the shares are shorted. It's really going to create pressure for those short sellers to buy shares, and that would further drive up the price of the stock. Next one is Zim, which is another heavily shorted stock. And Zim had huge years when we had, the pandemic driven supply chain demand. And now they have kept up with the volumes, but the shipping rates are really low. Well, I don't believe shipping rates are going to stay that low forever. And I know that we have kind of a shipping rate winter or down point, down period, I should say. But I think as shipping rates recover, Zim is going to be very profitable, and you're getting a really good company at a huge discount. So it's good to see that stock really pop at 8% on the day. That's heavily shorted. So if it continues to rise, I think it's going to put pressure on the short sellers. What didn't work today was consumer staples, Kroger, grocery store. It's a mid-sized position for me. It is one of those that is nice and safe. It's part of my income portfolio, but it was down. I am excited about Kroger's acquisition of Albertsons. I think they're going to have greater scale, greater profitability. Kroger makes it a habit of buying back shares and paying a reasonable dividend. Producio, I wasn't quite sure why it went down today. These guys do higher ed. They've been growing, very profitable. They actually do distance learning quite well. So it was good to see that they dropped in price. I bought more shares of Producio. Allstate was down, and I bought more shares. Not sure why they were down today. I think interest rates led investors to believe that they're going to make less money, because the way insurance companies make money is they collect policy premiums and then they invest them. So I guess the investors believe that with a dropping interest rate, Allstate's not going to make as much money on their holdings, which might be true. But overall, this was the Allstate company didn't have a very good year last year and the year before. So this was, they really have cleaned up their business, and their business is healthier than ever. And I invested in Allstate because I saw that the business got right. They really were doing things right. So there's a lot of good things going on for Allstate. And if you look at their stock price for the last 3 months, it's up substantially, up 25, 30%. So one down day is all right. Gave me an opportunity to buy more shares. So those are my top 3, my bottom 3. All right, so that is my last slide. Any questions before we wrap up? Really appreciate you joining the live stream. And if you could provide any feedback on maybe some things that you've seen that really look interesting in a live stream, I'd appreciate those comments. Any constructive feedback on something you think I can improve, I'd really appreciate those comments as well. All right, guys. So if there's no other questions, I hope the rally continues. We got one more day of trading this week. Chances are we're going to end, the 7th week where stock prices go up, which is really awesome. But I'm just expecting that maybe next week, there's going to be a pullback because, the party's got to end at some point. And I think I have one more question. Do you play earnings? No. I think your question is around, as an earnings call comes, do I buy or sell before the earnings report? So in general, if a stock, is goes down in price and the fundamentals tell me that, hey, I really like that business and I like that business, I tend to want discounts on stocks that are significant, not 5% or 10%. Some of the buys are at 50% discount. So I don't let the event of the earnings call really play into that decision. If, for example, Hewlett Packard had a bad earnings, I think 1 quarter ago, and going into that earnings, I wasn't changing my behavior. And then even after the earnings report, if I understand the company, Hewlett Packard's a quality company, I ended up buying more shares after it went down. I think it went down like 10% after earnings report of Q2, I believe. So I don't play earnings. Again, I like to keep my investing philosophy and plan as simple as possible because it's already super complex. When you look at what we have to look at from an information standpoint behind a company, it's already complex enough. So why put more decision points like, okay, the earnings are going to come. Should I buy ahead of earnings? Should I, play around with the earnings event? In my book, no. It's a good company or it's a bad company. If I'm afraid of an earnings report, I shouldn't be in the stock because that's if it's making me nervous that, hey, a bad earnings is going to sink the company. All right, I shouldn't be in that stock. MPW is a good example. There's plenty of bad news on MPW. Just look online and you have a lot of naysayers. You have a lot of bad press. But if you kind of separate yourself from that and look at the financials, in my case, I look at the financials for MPW. I see plenty of cash to cover all of their liabilities, all of their bills. If they make it, that stock's going to do really well. So I'm willing to invest in MPW. So good question. So I think it's a comment. I think we might have a red day tomorrow afternoon due to the quadruple witching. Now I'm going to search quadruple witching, by the way. Thanks for the putting it out there. I'm always up for learning, and I'm going to go study that up. And I appreciate you asking all the questions. I really do. And look forward to hopefully having you on the other live streams and seeing how we can help each other improve our portfolios and become more successful investors. All right, guys. Well, thanks so much for attending. Really appreciate it. Everybody have a good night and good luck investing out there.